Hello everyone, my name is Daniel Eban from Eban Portfolios, and now that the original planned lifetime of the fund is concluded, this presentation will describe the fund's performance and where to go from here. We'll start with a summary of the fund's performance, followed by a recap of the economy and a deeper look into the portfolio's returns in comparison to our benchmarks. It will then be analysed on the individual stock level before detailing my recommendations for the future of the fund. Anyway, onto the summary. This fund was a growth-focused portfolio. We managed to keep it growth-focused for the length of the investment, even despite COVID. Additionally, we managed to produce a magnificent return of 207%, the equivalent of a 20.57% annual return over the 6-year lifespan of the portfolio, bringing the total value of the fund to $307,252,204. This was far higher than that of our benchmarks. Morgan Stanley's growth fund only returned 13.96% yearly in the same period, and the S&P 500 was even worse at 9.41%. This resulted in an alpha of 7.85%, which meant that this fund had an extra 7.85% performance every year on top of the return expected from its risk exposures. The major events that shaped this fund's performance were the US's trade war with China, COVID-19 and the market's rebound, and the recent high inflation and interest rates. Based on all of this, it is recommended that the portfolio is continued but pivoted towards a focus in tech to capture this new market opportunity. To start with, the major events that shaped the economy these past 6 years will be explored, as they provide the backdrop for how the portfolio did. Firstly, there were 2 different presidents during the course of the fund. Donald Trump was elected shortly after the fund's creation and brought in many positive business policies, such as reduced corporate tax. Joe Biden came into power near the end of the fund's life in 2021 and helped to navigate America out of the COVID recession through stimulus packages. While both of them had fairly good presidencies, there were a couple of problems that came up out of their tenures. Firstly, Donald Trump initiated a trade war with China that experts generally agree that the US lost. And there were a number of problems with fiscal policies, mainly interest rates. In 2018 as well as 2022, interest rates were hiked as a way to stop inflation, but this had a disastrous impact on the economy. This impact will be explored later on, but it resulted in the first years where the market shrank since the GFC. However, during COVID, the interest rates were reduced to zero as an incentive for businesses to borrow to keep themselves afloat during that time period. So that, along with the stimulus packages they used, helped keep the market alive. Which brings us to arguably the most important economic event of the past 6 years, the COVID pandemic. The economy shut down and the market lost 34% of its value during the dip, but it managed to rebound exceedingly quickly, being back up to pre-COVID levels by July, and then going on to give a total return of 18.4% in the year. This rebound presented as an excellent opportunity to grow the portfolio that was made full use of. However, throughout 2022, inflation from the stimulus packages used during COVID-19 dragged down the market, resulting in a negative 18.32% return during 2022, which counteracted the returns produced in 2020 and 2021. Now the overall portfolio's performance will be discussed. As can be seen, it did very well and resulted in an annual return of 20.57% or an accumulated value of $307,252,204. As mentioned previously, most of these movements can be explained by what was happening in the market at that time. The first dip was due to high interest rates and the trade war. The second dip was due to the COVID-19 pandemic. The massive growth during 2020 and 2021 was due to the market rebound coming out of lockdown, and the horizontal movement at the end was due to high interest rates and inflation. To truly see how the portfolio fared during these segments, though, it must be compared to benchmarks. In this case, the S&P 500 was chosen, as it represents the American market as a whole, and the Morgan Stanley Growth Portfolio was chosen as it represents a comparable growth fund managed by a large financial corporation. It can be seen that our portfolio was quite a bit more volatile, with higher peaks and larger dips, but it also gave consistently better returns. The annual average return for our portfolio was 20.57%, whereas the average for Morgan Stanley's growth portfolio was only 13.96%, with the average for the S&P being only 9.41%. Looking more at how it fared in different scenarios, it can be seen that the 2018 interest rate crisis affected our portfolio far harder than the other two, as did the dip from COVID-19. This is probably just an issue of perspective though, as upon closer inspection, the S&P 500 portfolio actually lost all of its gains from the previous years in both of these crashes, landing at around the $100 million mark both times. Because of this, our portfolio definitively outperformed the others during the COVID rebound, rising up to $400 million before dropping off due to high inflation. The differences described before can be seen here as well. As described previously, our portfolio had the highest returns, but also the highest standard deviation of returns, followed by Morgan Stanley and then the S&P 500. What this meant is that although we resulted in the highest growth, we also had the most volatility. This is to be expected though, as returns are always a risk-return trade-off. Investors can only make a return because they are being compensated for the risk they take on. Therefore, oftentimes, the best indicator of a portfolio's performance is actually risk-adjusted returns instead of straight returns and volatility. These can be seen here. Combining the returns and standard deviation of returns, we get these metrics. Thankfully for us, the same pattern emerges here, with our portfolio being the highest, followed by Morgan Stanley and the S&P 500 being in last. What this means is that not only does our portfolio have the highest returns, but also has the highest risk-adjusted returns, meaning that investors in this portfolio are better compensated for the risk they are taking on than investors in the other two. The first metric is the Sharpe ratio. It is, as I said before, a measure of risk return, and it represents the amount of return you receive for each unit of risk you take on. The trade-off ratio is similar, but instead of using standard deviation of returns, it uses the beta of the portfolio. This has the effect of only considering systematic risk, and it can be a more reliable measure depending on the unsystematic risk of the portfolio. In this case, none of the portfolios actually passed the good Sharpe ratio of 1, but that was likely because of all of the market volatility caused in the past 6 years due to events like COVID. The Sortino ratio is also similar to the Sharpe ratio, but instead of using the entire standard deviation, it only uses the downside standard deviation, which means that it doesn't actually count unexpected positive returns as a bad thing like the Sharpe ratio does. All of the portfolios did significantly better in this, which indicates that there was more upside volatility than downside volatility, which makes sense given the bull run at the end of 2020 and 2021. Finally, the information ratio is a combination of the returns portfolio generates above the benchmark, which is the S&P 500 in this case, and the tracking error, which is how closely the portfolio matches the index. It is used to determine whether a portfolio is exceeding the benchmark and whether or not it is doing that consistently. As can be seen, both our portfolio and Morgan Stanley's portfolio had a similar information ratio, which was likely due to our higher standard deviation. After calculating these important ratios, a Farmer-French analysis was then performed on both of the portfolios. As can be seen, Morgan Stanley had far greater exposure to more risks, as will be explored. Firstly, they had more exposure to market risk, which is just its beta. This indicates that it has more systematic risk. Secondly, while our portfolio had an insignificant exposure to the size factor, they had a positive correlation, which showed that they have exposure to small market cap stocks. Thirdly, both portfolios had exposure to the value factor, which makes sense, as that is the indicator for a growth portfolio. However, Morgan Stanley's portfolio had a far higher exposure than us. Interestingly though, while our portfolio had an insignificant exposure to both the profitability factor and the investment factor, Morgan Stanley's portfolio was highly negatively correlated with both of them. This meant that they were exposed to companies with weak operating profits and aggressive investment strategies. This isn't necessarily a bad thing, but they would want to see extra profit to compensate investors for that extra risk. However, this was not what they saw, and hence their alpha, while still significant, was considerably lower than ours. Our portfolio managed to return an alpha of almost 8% per annum, which means that our portfolio outperformed a completely diversified portfolio with the same risk factors by 8% every year. This return is a triumph and a confirmation of the confidence that you investors place with us by investing in this fund. To dive deep into some of the reasons why a portfolio performed so well, we'll first look at the daily returns that the portfolio produced. As can be seen, it's almost symmetrical, but is slightly biased towards positive returns, which is expected. We can quantify some of these observations using these measures. The mean of these returns was 0.09%, which as mentioned before is slightly positive, and the standard deviation was 1.61%, which is also quite high. This was expected though, as the market is known to be very volatile. Additionally, while it looks like a normal distribution, it actually differs slightly from one, as can be seen by the skewness and the kurtosis, which in a normal distribution would be 0 and 3 respectively. The slightly negative skew means that while it is biased towards positive gains, it is also biased towards large negative losses, as opposed to large positive gains. This is caused by the market, as the large gains are generally the result of lots of little gains, whereas losses are generally more dramatic, as in the case of COVID. The high kurtosis score implied that while returns were generally in a narrow band, there were far more outliers than you would generally expect from a normal distribution. This could be explained by the fact that large market movements are actually far more common than a normal distribution would expect, and therefore large gains and losses happen fairly frequently. Next, the performance of some constituent stocks will be analysed. This stacked graph shows the contribution each stock had to the portfolio's total returns. The graph can be used to conduct a preliminary look into which stocks played the largest part in each major event. That first dip in 2018 seems to have been caused by Amazon and TPL, which makes sense, as TPL is a real estate company and would therefore be affected by interest rates. The COVID drop seemed to be predominantly caused by Visa and TPL once again. This is less because they were particularly susceptible to it, and more because the large tech companies were immune, as will be discussed later. Next, the market rebound from COVID seemed to be largely made up of Apple, Amazon, and Tesla, which once again makes sense because they are the ones that stand to gain from increased consumer spending, which happened due to the COVID stimulus packages. Finally, the horizontal movement seemed to be caused by a simultaneous decline in Amazon and increase in TPL. But the problem with this chart is that, while it does show returns, it also mixes in weightings, so it can cause some movements to look more dramatic than they actually were. Therefore, the weightings and then returns were investigated separately. These are the weightings of each stock throughout the life of the portfolio. As can be seen, the stocks that has significant weighting were Apple, Amazon, Monster, the Texas Pacific Land Corporation, Visa, and Tesla. Because these stocks were the ones that had the greatest impact on the performance of the portfolio, their returns were graphed. Immediately, one thing is obvious. Tesla performed ridiculously well, but was also ridiculously volatile. Over this period, it managed to gain almost 3,000%, peaking at 29 times returns. But then it also lost almost 70% from that peak, ending at only 8.6 times returns. The initial rise was due to a speculated and actual increase in demand for electric vehicles across the world during 2020 and 2021. And the dip in 2022 was mainly due to the CEO, Elon Musk, making a sequence of bad decisions, such as his infamous acquisition of Twitter. It is likely that this massive dive was a large contributing factor to the portfolio's poor performance in 2022, given that Tesla stayed at a fairly consistent 8% weighting in the portfolio over that period. Now looking at the rest of the stocks, it can be seen that TPL did exceedingly well, especially in 2022, which likely counterbalanced Tesla's dip. TPL's strong performance in 2021 and 2022 can largely be attributed to oil prices. Their main business is leasing land to oil companies, so it is a major driver of cash flows for them. Oil had a massive resurgence after COVID, climbing out of its trough in 2021 and peaking at $116 a barrel in 2022, up from a pandemic low of just $18 a barrel. This was a 5 times increase and had the effect seen on the stock price. Because this movement was happening at the same time as Tesla's drop, it is likely that this counterbalanced it, as TPL's portfolio weighting by the end of 2022 was over 30% on account of its exceptional returns. However, it wasn't just Tesla that TPL was counterbalancing, as most tech stocks were down in 2022. Analysts think that this crash in the tech sector, which ended up declining 27% in just a few months, is less of a sign of bad things and more of a natural readjustment. These stocks soared during COVID because they were seen as a safe investment during the pandemic, given that they all use the internet and not face-to-face interactions. This led to many of these stocks becoming overpriced. This continued for a while, but it was only in 2022 when investors started to realize that they were actually overvalued, which led to this drop. For a final look at the individual stocks, I've also prepared a violin chart, which shows how common certain daily returns were. In this view, it can be seen just how volatile TPL and Tesla really were. In just one day, TPL lost 27% of its value, but then on the flip side, it gained 20% of its value in just one day as well. Tesla had a similar track record, and while it never quite got that volatile, it consistently had daily returns of over 10% and under negative 5%. Zooming in though, it can be easily seen that while TPL and Tesla were the most volatile, they also had the highest average returns, shown by the dotted line. This correlates with what was seen in the previous line graphs. Now let's look at the seasonality of our portfolio. As can be seen, there were many good years for the portfolio, with 2020 being a standout year. While the market did not do as well that year due to COVID, this portfolio's high exposure to tech stocks resulted in a spectacular return during the COVID rebound. Additionally, while the market had a negative return in 2018 due to exceedingly high interest rates, our portfolio managed to stave off a negative return through its high weighting in Visa, a stock that actually went up during it. The last year of note was this year, 2022, in which many stocks that boomed during COVID underwent a correction and dropped up to 27%. Our exposure to this correction seemed to be about the same as the markets, despite our high weighting in tech stocks that were especially sensitive. So this was a relatively good result, all things considered. Finally, we will also consider which months the portfolio did better or worse in on average. As can be seen, it is generally random, with a couple of exceptions. December was low following on to January, which gave on average very high returns, and this can be explained by something called the January effect. This effect says that investors like to sell stocks in December and then buy them back in January for tax purposes, causing the dip and rise seen. There is a similar story for September, which is once again known as the September effect. It is not really known what causes the September effect, but it is hypothesized that it is just driven by investors selling stocks at the end of summer. So, now that all that has been said, where to now? Should this portfolio be shut down and liquidate, or should it be allowed to continue to operate? Recently, the portfolio suffered large losses of 21% of its value in 2020, so I can understand if you're a little bit hesitant about the future of this portfolio. However, I would argue that this portfolio's best days are still to come, and that it should be allowed to continue going into the future. It has made an average return of 20.6% per annum, and even in 2022, it was not the selectivity of the stocks that made it go down, but rather the market itself. Additionally, now that the market is down, now is the perfect time to buy into it and ride the wave as it recovers. Tech stocks are currently the cheapest they have been in over a decade, and still have plenty of growth left in them. Therefore, my recommendation is to keep the portfolio running and pivot to a tech-oriented focus to capture this new opportunity for outsized returns. Therefore, in summary, this portfolio has been the golden goose of this company for the past 6 years. It's given outsized yearly returns of 20.57% and had a total growth of 207%, bringing the cumulative value up to $307 million. This was far better than the market and resulted in alpha of 7.85% a year. Our recommendation going forwards is to continue the portfolio and focus on tech stocks such as Netflix and Nvidia, which we believe have ample room for growth. Thank you so much for investing these past 6 years with us, and thank you for entrusting us with your capital. We hope this will not be the end and that you will continue to partner with us well into the future. Thank you.